Okay, let's jump right in.
Yeah, let's do it.
Because we're starting this deep dive with a number. A figure that, when you really look at it, it shouldn't be possible.
It shouldn't exist.
Yeah.
Not in a functioning market.
And when you dig just a little bit beneath the surface, you realize it's pointing to a global financial scandal of, well, staggering proportions.
And that number is $11.
$11. So if you look at the price of silver right now, the one that flashes across your screen, the spot price, silver is about, what, $79 an ounce?
$79. And that figure is, to put it bluntly, a lie.
A lie.
It's an artificial price. It's mathematically impossible when you look at what's happening in the real world with real physical demand.
Okay, so here's where the story really starts. If you ignore those paper exchanges in the West, the COMEX in New York, the LBMA in London,
Right.
and you look at where the actual tangible physical metal is being traded, specifically in Shanghai.
On the Shanghai Gold Exchange, the SGE, the biggest physical exchange in the world.
The price there is not $79. It's consistently trading around $90 an ounce.
That's the $11 gap.
Yeah.
An $11 premium, which is roughly 14% higher.
And just to put that in context for everyone, think about any other global commodity.
Oil, gold, corn, anything.
If you saw a 14% price gap between New York and Shanghai that just stayed there.
It wouldn't. The laws of market efficiency say that gap closes in, literally milliseconds.
Sure, algorithms, hedge funds, they'd jump on that instantly.
They'd flood the cheap market, buy it up, sell it in the expensive one, and pocket the difference until the prices were identical.
But with silver, that's not happening.
Not only is it not happening, the gap is getting wider.
So that persistent $11 gap, that's the smoking gun.
It is. It proves beyond any doubt that the Western price is controlled. It's artificial. It is completely and utterly divorced from physical reality.
So our mission for this deep dive is to investigate that gap. We're treating it as the scandal it is.
A structural failure.
Exactly. A failure that is allowing a slow, continuous industrial-scale drainage of strategic Western silver reserves.
We are literally watching the family silver of the West being sold to the East at a 14% discount.
Let's really detail this disparity. We've got the New York COMEX price at $79.
Right. That's the price most people see on TV. It drives financial sentiment. It's the paper value.
And then you have the Shanghai Gold Exchange price at $90.
Which is the price of genuine physical industrial necessity.
It's a complete illusion, then.
It's an illusion with very real-world consequences. We're talking about a systematic transfer of wealth.
And it exists because the two markets are measuring totally different things, right?
Fundamentally different things. COMEX is a derivatives market. It trades paper futures, options, promises.
And something like 99% of those contracts never end in someone taking the metal.
Exactly. They're just settled in cash. The $79 price is set by leverage speculators, betting on margin, looking at charts.
And a lot of those are short sellers, right? People actively betting the price will go down.
A huge part of it. They have to keep suppressing the paper price to make their bets profitable.
Mm-hmm.
It's all built on the assumption that the physical supply will just always be there if needed.
It's a game of paper promises.
Whereas the SGE price, the $90 price, that's what you pay for actual physical metal. Metal that has to be delivered, assayed, and stored.
Its whole purpose is different.
Its core mandate, and this is backed by the Chinese government, is to make sure industrial users, think solar panel manufacturers, electronics factories, can get the physical inputs they need.
Just to keep the lines running.
That's it.
Okay, I get the difference between paper and physical, but even so, in a functional global economy, they have to connect at some point. A 14% profit shouldn't last a day, let alone months. What is stopping that instant arbitrage?
That is the critical question. The gap doesn't close because there's a physical speed limit on the commodity.
A speed limit, okay.
Think about it. Arbitrage for something like Apple stock is instant because it's all electronic. You can buy in New York and sell in London in the blink of an eye.
But you can't just click buy on silver in a New York vault and have it instantly appear for sale in Shanghai.
Exactly. The process is, it's heavy. It's logistics heavy, capital intensive, and it takes time.
So when the smart money, as we call them, buys a COMEX contract,
They have to stand for delivery.
yeah,
That means waiting days, maybe weeks for the bar to be moved, assayed, verified for purity, and legally transferred.
then you've got to ship it.
You've got to ship it. And that whole process introduces costs and friction that simply don't exist in the paper world.
So the paper market is trying to force its $79 price on the world.
Right.
But the physical reality of actually demanding delivery, verifying it, shipping it, that creates a bottleneck.
A friction point, exactly.
Yeah.
And it allows these two markets to exist in separate realities, like having two different currencies for the same thing.
And the fact that the gap is widening,
Yeah.
what does that tell you?
It tells us the paper market is failing, fundamentally failing. The short sellers and the paper traders, they cannot physically deliver enough metal to satisfy the demand that the arbitrage creates.
So the people who actually need the metal for manufacturing, they just ignore the $79 price.
They're happy to pay 90 because they're buying reality while the West is pricing based on hope.
Which brings us back to this being a rigged game. The widening gap means the COMEX shorts are getting more and more vulnerable.
Because their ultimate promise delivery is becoming impossible to keep. And this whole arbitrage process is, as you said, literally selling the family silver.
It's the ultimate resource extraction at a discount.
These huge multinational commodity houses, they're just exploiting this fracture for risk-free profit. Buy at the Western discount of 79, ship to China for that guaranteed $11 profit.
And every single one of those 1,000-ounce bars leaving a Western vault is strategic wealth.
Leaving at a price 14% below its true global market value, a value determined by the biggest industrial power on Earth.
And once that bar lands in Shanghai, gets melted down and put into a solar panel or a 5G tower, it is gone.
It's permanently removed from the global financial float. That silver is not coming back.
To really get the gravity of this, we have to visualize the scale of it. And I think the perfect way to do that is the siphon analogy.
It's the perfect analogy. This isn't just a few trades here and there. It's a sophisticated, continuous, industrial siphon.
Pull in strategic liquidity out of Tank A.
The aging, paper-heavy Western vault.
I'm humping it straight into Tank B.
The metal-hungry manufacturing powerhouses of the East.
And when you say smart money is doing this, who are we talking about?
We're talking about the biggest players, the ones who can handle massive logistics and capital. Think giant commodity traders like Glencore, Trafigura,
Okay.
and crucially, major Chinese state-owned and commercial banks. Their explicit job is to secure these resources.
So let's break down the step-by-step process. How do they actually execute this trade?
Okay, step one. The arbitrager, let's call them mega trader core, they buy a huge number of futures contracts on the COMEX.
Paying the paper discount, $79 an ounce.
Right. They might buy 100 contracts, which is 500,000 ounces of silver on paper.
And step two is what separates them from a normal speculator. They don't just flip the contract.
No, they hit the take delivery button.
And that forces the COMEX warehouse system to physically hand over the 1,000-ounce bars.
And that action is what removes the metal from the exchange's registered inventory. That's the key stock, the metal that's immediately available for settlement.
This is where that friction you mentioned comes in.
100%. They have to arrange secure transport, check the assay certificate to make sure it meets China's strict purity standards. There's customs paperwork. It's a headache.
But an $11,000 profit per bar makes the headache worthwhile.
Absolutely. So step three, they don't store it. They charter specialized air freight. We're talking heavily secured Boeing 747 cargo planes loaded with millions of dollars of physical metal, flying it straight to Shanghai.
And step four is the easy part.
Easiest part. On landing, it's immediately sold on the SGE for that guaranteed $90 price.
Yeah.
The deal is already done.
So let's talk profit, even after you factor in the flight, insurance, security, all that.
Which might be, say, $1 to $2 an ounce?
You're still left with $9 or $10 of pure risk-free profit per ounce.
Which is $9,000 to $10,000 per bar.
That is just an insane incentive.
It's so powerful, it overrides everything else. You're not trying to predict the market. You're just executing on a known systemic failure over and over again.
And the proof that this siphon is running constantly, you just have to look at the water level in the source tank, the COMEX inventory.
That's the irrefutable evidence. You have to look at a specific category. Registered inventory.
The metal that's actually available for delivery.
The unencumbered stuff. That stock is collapsing. It is down a staggering 70% from its peak just a few years ago.
70%, that's not a market fluctuation, that is a statistical collapse.
It is.
What does that actually represent, though, in terms of, like, days of supply?
That's the crucial context. The total registered inventory is hovering dangerously close to what analysts call the danger zone.
Which is what number?
Around 30 million ounces. And to give you some scale, Global industrial demand is hundreds of millions of ounces a year.
So the available saleable inventory is shrinking to a tiny fraction of what's needed.
Exactly. The siphon is running dry. The paper promises were built on a foundation of physical metal that is now being systematically ripped out from underneath them.
So these inventory charts hitting historic lows. That's the fire alarm,
It's signaling an imminent, catastrophic change in market reality.
which forces us to ask that core question again, why? Why is China willing to pay a 14% premium month after month?
It all comes down to a clash, a fundamental clash between financial instruments and physical necessity.
We've established the Western price, the $79 price, is just financial speculation.
It's people trading money on paper, making bets.
The Eastern price, the $90 price, that's about survival.
Economic survival, absolutely.
Yeah.
The East is basically saying, we don't care about your paper price. We need the actual metal to function.
And the scale of that industrial demand is just immense.
It's staggering. China produces roughly 80% of the world's solar panels,
80%.
and they dominate electronics, 5G components, defense applications. Silver isn't a luxury for them. It's an irreplaceable, essential component.
And it's not like their need is shrinking. The newer, more efficient solar panel technologies actually require more silver.
Significantly more. Sometimes up to 50% more per panel than the older designs. Their need is accelerating.
So let's put ourselves in the shoes of a factory manager in China.
Okay, you're running a massive solar plant. Millions of panels, tight delivery contracts. The cost of a 1,000-ounce bar is, say, $90,000.
But that one bar is just a tiny fraction of the total cost of production. You've got silicon, glass, labor.
Precisely. Now, what happens if you run out of silver paste?
The entire assembly line stops.
The whole line stops. And that costs the company millions per day. Lost revenue, contract penalties, all of it.
So compared to that catastrophic loss, paying an extra $11 an ounce is nothing.
It's trivial. It's the cost of doing business.
That is the classic definition of inelastic demand.
It's perfectly inelastic. The cost of not getting the metal is so much higher than the premium. They have to pay $90, $95, even $100 if they have to, because the alternative is shutting down 80% of the world's solar production.
So for anyone listening, trying to figure out what silver is really worth,
The physical market, driven by the existential needs of the world industrial engine, will always win against a paper market driven by bets.
the $90 price is the real floor.
It is the real floor. And it's completely ignoring the paper discount from New York. The West is living in a financial fantasy, and that fantasy is ending.
It's just so clear when you put it that way. $79 is a measure of faith in a failing paper system.
And $90 is the hard cost of manufacturing the future. One is a speculation, the other is reality.
Okay, so while COMEX in New York is dealing with this collapse in registered inventory, what's happening in London at the LBMA?
London is a different story. It presents maybe a more insidious illusion of wealth.
How so?
Because on paper, London's vaults hold vast stockpiles of silver. The headline numbers look massive, often hundreds of millions of ounces. So people think, oh, there's no shortage.
But those numbers are misleading.
Deeply misleading. They represent the total metal in the vault, not the metal that's actually for sale.
So what's the catch?
Most of that metal is classified as encumbered.
Meaning it's already spoken for.
Exactly. It's physically there, it's verified, but it's already owned and legally tied up by someone who isn't selling.
Like who owns all this metal that isn't for sale?
Primarily, you're looking at the massive silver ETFs like SLV.
Right, one of the biggest paper proxies for silver?
Those ETFs hold physical metal on behalf of their shareholders. So those bars are allocated to the ETF, and they are not available for an arbitrager to come in, buy, and ship to China. They're encumbered.
And it's not just ETFs.
You also have central banks, large private family offices, sovereign wealth funds. They all use London vaults for secure, long-term storage. They're not sellers.
So if you strip all of that out, the ETF metal, the central bank metal, what's actually left? What's the available supply?
What's left is what we call the flake, the truly liquid silver. And that's the only part of London's stockpile that the siphon can actually drain.
And what do the analysts say that number is?
The analysts who track these vault movements estimate that the actual amount of liquid silver available for sale at today's price is critically low, potentially near zero.
Near zero. So the historic trading hub for global bullion is effectively empty of saleable liquidity.
That's the staggering conclusion. A global physical shortage is being masked by a giant headline number that's already legally spoken for.
How do we know that's not just speculation, though? Is there a tangible metric that proves this illiquidity?
There is, and it's the definitive smoking gun for real scarcity. We look at the cost of borrowing the metal.
You mean silver lease rates?
Silver lease rates. When a bank needs to borrow physical silver for a short period, maybe to cover a delivery, they pay a rate. When those rates spike, it tells you something.
It tells you there's a fierce competition for the tiny amount of physical metal that's left.
Precisely. It means they're willing to pay a much higher fee just to get their hands on an ounce, which proves the market is acutely illiquid.
They're scraping the bottom of the barrel.
That's a perfect way to put it. And if these giant financial players can't easily get their hands on metal, they certainly can't get enough to flood the market and push the price back down.
So this structural illiquidity in both New York and London is why the paper price is failing.
It's why the $79 illusion can't hold the line against the $90 industrial reality.
This continuous drain, the illiquidity, it forces us to shift our tone a little bit. We're not just analyzing a price gap anymore. We're looking at an approaching systemic failure.
We have to. We have to consider the ultimate risk for anyone holding silver in paper form.
We're heading for the breaking point. The moment the paper market finally defaults on its promise to deliver.
This is the force majeure scenario.
Yeah.
And every single person holding paper silver needs to understand what this means.
So force majeure is basically the legal escape clause.
It's the act of God clause, an unforeseen event that makes it impossible to fulfill a contract. For the COMEX, it would be the declaration that they simply cannot deliver the metal they promised.
But wait, wouldn't the regulators, the CFTC, step in? I mean, the registered stocks are down 70%. Why is the system being allowed to run this close to the edge?
The official narrative is always that the market is functioning fine, that the metal being removed is going to legitimate holders, and they're monitoring the situation.
But the data tells a different story.
The data tells the real story of the siphon operating completely unchecked. And when the failure finally hits, no amount of oversight is going to matter, because the physical metal just won't be there.
So let's walk through the default scenario. What's the trigger?
The trigger is one day, a really big player, a massive industrial user, maybe a sovereign wealth fund, decides to stand for delivery of a huge amount.
Like how much?
Let's say 50 million ounces. A non-negotiable demand for a physical metal right now.
And the COMEX looks at its registered inventory, which is now below that 30 million ounce danger zone.
And they realize it is physically impossible to meet that demand. They will declare, we cannot fulfill this obligation.
Then they trigger an emergency procedure.
A liquidation-only ruling or a formal declaration of force majeure.
And what happens in that instant to everyone else holding a paper contract?
This is the ultimate rug pull. The exchange enforces the cash settlement clause. Everyone holding a paper contract is forced to settle in cash.
At the last traded paper price.
The last paper price before the default. Let's stick with our number. $79. You get $79 in cash deposited into your brokerage account.
So I have cash, which a moment ago represented a claim on an ounce of silver. But the whole reason for the default is that the metal is gone. So what happens to the price of a real physical ounce?
It completely separates. The paper price becomes irrelevant. It's effectively zero, because the system that created it just failed.
Well, at the same time,
The physical market, realizing silver is now officially unobtainable, will gap up overnight, instantly.
because everyone with that now useless cash will rush to the few dealers who still have actual inventory.
Exactly. Demand becomes infinite and supply is proven to be finite. The real price on the street could spike to $150, $200. Who knows? The metal becomes unobtainium.
So I'm left holding $79 that cannot buy the asset I thought I owned, because that asset now costs $150.
You lose. Your paper promise protected you right up to the point of failure, and then it became worthless. That is the critical warning. If you hold unallocated paper silver, you are completely exposed to this.
Let's zoom out and look at the bigger picture here. This $11 arbitrage isn't just a market glitch.
Not at all.
It's a profound strategic transfer of power happening right under our noses.
And China's willingness to pay that premium isn't just because they need it for factories. It's a calculated, deliberate act of resource nationalism.
This connects back to the bigger geopolitical trends we've talked about before.
It does. It's about nations moving away from holding depreciating assets, specifically U.S. Treasury bonds.
Which are losing real value because of inflation and debt.
So this silver siphon is the physical mechanism for that strategy. China is literally converting its devaluing dollar reserves.
Into tangible strategic commodities.
They're swapping paper promises for the real assets needed for global dominance in the 21st century. It's not just silver, it's copper, lithium, cobalt. But they're getting our silver at a 14% discount.
And by draining the West of its registered silver, they achieved two massive long-term goals.
First, they secure their own manufacturing, future solar, 5G, EVs. And second, and this is the more ominous part, they gain incredible leverage over Western industry.
And Western military needs.
We have to be crystal clear on this.
Yeah.
Silver is central to national defense.
High-performance military applications, guidance systems, missiles.
Stealth technology, jet engines.
Mm-hmm.
Imagine a scenario in the near future where there's a national security crisis and the U.S. military suddenly needs a huge amount of high-purity silver.
But the domestic supply is gone. The vaults are empty. The only source is Shanghai.
Now the U.S. has to go, cap in hand, to China to buy back its own strategic metal at a massive premium. Or worse, face production delays because it's just not available.
That turns us from a financial story into a full-blown national security crisis.
And governments can't tolerate that. They can't let a strategic competitor control essential defense inputs.
And the smart money the arbitrage is running the siphon right now, they know this.
They are anticipating the inevitable government response.
Which would be what?
The logical historical response is for the U.S. government to declare silver a strategic resource and ban exports.
An export ban. And the moment that happens, the global market fractures. The arbitrage stops overnight.
But the domestic U.S. price for physical silver will explode upwards, because now it reflects true domestic scarcity.
And the metal in your hand becomes priceless.
The message is undeniable. The geopolitical borders are closing, this strategic resource is moving east, and the window to secure it on the right side of that fracture is closing fast.
Okay, so the system is approaching failure. The question for anyone listening is no longer if it will break, but how to position yourself. We need a playbook.
An actionable strategy. And we have to start with two critical warnings. First, avoid unallocated accounts. If your silver is in a bank pool account, you are just an unsecured creditor.
You don't own a specific bar. The bank just owes you an ounce of silver.
And if that bank goes under, you're standing in line with every other creditor hoping to get pennies on the dollar. You have to get it allocated, or better yet, get it out.
Okay, that's number one. What's number two?
Number two is you have to monitor the vital signs. Watch the COMEX registered stocks.
Know when the siphon is truly about to run the tank dry.
Yes. The consensus is that the critical threshold, the danger zone, is when that registered inventory number drops below 30 million ounces.
Every ounce below that, the probability of that force majeure event just skyrockets.
It does.
Okay, so now let's get to the core debate. How to actually own the metal. There seem to be two main strategies.
Two primary approaches, and they represent two different philosophies. One is about accelerating the failure, and the other is about pure protection from it.
Let's call them Strategy A and Strategy B. Strategy A is the squeeze play.
That would be using something like PSLV, the Sprott Physical Silver Trust.
Why PSIV specifically? What makes it the king of silver ETFs?
Because unlike a lot of other ETFs, its entire model is based on physical metal. It's legally required to hold fully allocated, audited, physical silver bars outside of the commercial banking system.
And the key part is what happens when new money comes in.
That's the crucial mechanism. When people buy new shares of PSLV, the trust is forced to go into the open market and buy more physical silver bars to back those shares.
So buying a share of PSLV translates directly into more physical metal being taken out of the market.
It acts as another siphon. It runs alongside the Chinese arbitrage, contributing to the drain and putting direct pressure on the COMEX. It's a way to use the financial system to break the financial system.
You're actively participating in the squeeze.
You are. But there is still a sliver of counterparty risk. The metal is held by a third party, not you.
Which brings us to Strategy B.
Strategy B, physical in your hand. The protection play.
The advantage here is simple.
It is absolute and total. Zero counterparty risk.
If the COMEX defaults, the banks close, the power goes out. The physical metal in your home safe is still yours, 100%.
It's ready to be exchanged for whatever you need at the new, much higher physical scarcity price.
But we have to acknowledge the drawback right now.
Of course. The premiums on physical metal are high, 20% or more above that paper spot price.
It feels expensive to pay $95 for an ounce when the screen says $79.
It does. But what you're buying is ultimate security. You're sacrificing some short-term price efficiency for total, irreversible protection against that force majeure event.
So the choice for you, the listener, is a risk calculation.
Do you want to join the squeeze and help accelerate the break by buying something like PSLV? Or do you want absolute, immediate protection and are willing to pay the high premium for it?
Either way, the message is clear. Own the metal, not the paper promise.
The silver is moving east. You have to decide if you're going to secure your peace before the final drops are drained and the government slams the gate shut.
So let's just do a final summary of this investigation. We've uncovered a market scandal defined by an $11 price gap.
And that gap is the indisputable evidence of a profound, critical shortage of physical silver in the West.
A shortage that is being masked by a broken paper pricing mechanism.
We've shown how the siphon, this arbitrage, is systematically draining strategic wealth from New York and London to Shanghai.
And this drain, driven by inelastic industrial demand, will inevitably break the paper market. It will end in a force majeure event,
where paper holders get cash settled at a price that's meaningless compared to the real value of the metal.
And finally, we have to see this for what it is, a massive geopolitical transfer of power.
The East is converting depreciating paper dollars into the essential resource for the 21st century economy and gaining irreversible leverage in the process.
So let's leave everyone with one final provocative thought.
The paper price is artificially held down at $79. The real industrial floor price, set by necessity in Shanghai, is $90. So if you're kicking yourself for missing silver when it was $30 a few years ago, maybe adjust your perspective. You have to recognize that $79 is still cheap.
If the real price is actually headed somewhere far higher.
If the structural reality, the proven scarcity, the industrial urgency, is pushing us towards a price like $300, which is what some projections show once the paper system breaks.
The vacuum is running. The vaults are draining. That $79 price is an expiring offer to secure strategic wealth at a discount.
And you have to decide which side of that border you want to be on. The side left holding cash from a defaulted contract, or the side holding the metal that the modern world is desperate for when that gate closes for good.